Hello, and welcome to FGIA's Teaching Tuesday webinar series, your monthly connection to timely topics within the fenestration and glazing industry. This is Janice Iglesias, FGIA's Executive Director. Thank you for joining us for today's presentation, Financial Management and Value Preservation in a COVID Economy. This webinar is being recorded, so it can be made available online for on-demand viewing for your future reference, or to share with a colleague who was unable to attend. Since we are recording, all lines will be muted for the presentation portion of the session. A PDF of the presentation and the recording of this webinar will be emailed to you later this week. We encourage you to share today's webinar on social media using the hashtag you see here. FGIA's marketing team will be live tweeting throughout the presentation, so be sure to check out our Twitter feed for key takeaways. We will end today's webinar with a Q&A segment following the presentation, and we welcome your questions. Please send them in via the chat box at any time during the webinar. Our presenter today is Michael Collins, Partner and Managing Director of Building Industry Advisors. Working from Chicago, Mike leads a national building products M&A advisory and capital placement practice. His frequent presentations at building industry trade associations and conferences cover topics ranging from the outlook for the residential and commercial building products industry to maximizing the value of a building products company. Mike writes a column for Pro Sales covering M&A related topics in the LBM industry, and a column for Door and Window Market magazine, which covers trends in the door and window industry. If you're looking for more information on how businesses have been impacted by COVID-19 and the steps they can take towards recovery, the FGIA Virtual Summer Conference will cover these topics and more. Sign up today. Before we get started, as most of you know, on January 1st, 2020, AMA and IGMA officially came together to form a new united organization, the Fenestration and Glazing Industry Alliance, or FGIA. In October and December 2019, the AMA and IGMA boards held strategic planning meetings for the new organization, resulting in development of a vision and mission for FGIA. The strategic plan that was developed also identified 5 goal areas, which are consistent with past priorities of the separate organizations: advocacy, research and technical standards, community, education, and certification. And now on to today's presentation. Mike, we're looking forward to hearing from you.
Thanks very much. Thanks everybody, and thank you for joining us. Obviously, we're in this COVID situation together, and just trying to find new ways to keep in touch and keep ideas in front of the FGIA membership. And so appreciate everybody joining us today for this online presentation. I want to say at the outset, we have a number of important topics to cover, but I want to just say at the outset that obviously the first and most important aspect of any type of health crisis is protecting ourselves and our family and our workers and so forth. And so just so that as I'm going through this and presenting sort of the cold hard economic side of this situation, so to speak, it would be remiss not to really highlight the fact that the health and the human side of it is the most important part. But beyond the obligations we have to our employees and to our families to keep ourselves safe, as business owners, we have obligations to the employees that work at our companies to assess a situation like this and find the best way to navigate through it. And that's really the purpose of the presentation today. While I'll be talking a little bit about some specific things that you could do inside your company to safeguard the business, this was definitely not a presentation about that. It's more about, first off, the economic backdrop of this pandemic, which will be a very fast economic overview of how this has affected our economy, ways you can safeguard near-term profitability of your businesses, ways to improve your net working capital position, and then how to assess business valuations, whether your own or an acquisition target in a post-COVID environment. So let's start first with that economic backdrop. In the 8 weeks since COVID really has come to rest in our economy, 30 million Americans have lost their jobs. it's an unprecedented speed of job loss, and frankly matches an unprecedented situation. There was a Gallup poll recently that said that 1 out of every 3 Americans has either lost their job, has been furloughed, or has seen some kind of a reduction in their income. 1 out of 3. And so it's just about as widespread a problem as we could possibly have, and certainly took root much quicker than the last financial crisis. Now, I put this chart together because I wanted to take a look at the stock market's reaction to the COVID situation and put in perspective where this leaves us relative to where we've been in the past. Now, for each of the years listed, those are each a December 31st year end. I eliminated the dates because the slides got a little busy looking, but that's a December 31st year end close for the Dow Jones 30. And the more recent dates are sort of the dates by which, in January, we were becoming increasingly aware. February, it was being, much more clearly a problem. March, we were right in the thick of it, April and May. And so I wanted to just take a look and say, okay, well, how did the market react? Well, in uncertainty and high risk, the market just falls off very quickly. People have a flight to cash and they sell. But what we're seeing that's very positive is that it's flattened out and recovered a little bit in April, and now we'll be watching it day to day for each time there's good news, whether it's about a vaccine or levels tapering off and so forth, you'll see the market react positively. But essentially, this point that we're at right now has erased a couple of years of stock market returns. You see the red line there, it takes us back to about the 2018 level. But then look back to 2008, 9, and 10 when we were in the thick of the financial crisis. The value of the stock market currently is much higher than it was at that point, and really is indicative that even though the market is nervous, worried, uncertain, and so forth, it hasn't erased all of our gains and put us back to the point where the outlook is only as poor as it was back at that time period. So there's something to be said for that. Now, the International Monetary Fund maintains a whole team of economists that gauge and measure global economic activity. Going into this year, they had predicted a 3% global growth rate for gross domestic product for the entire world as a conglomeration. And in just 2 months, they've revised their projections so that now they believe that global GDP will shrink by 3% this year. Now, that's the bad news. The good news is that as long as the virus situation is seen to be getting contained by the end of this year, that it starts to fade by the second half of this year, vaccine would make it a foregone conclusion that the growth and recovery period could start. But basically, everything going in the right direction. It is believed that the growth rate in 2021 will return. The first half, it could be a 3.4% growth rate, and the second half, it could be a 5.8% growth rate, meaning a real strong rebound in the second half of next year that would hopefully get us back on track to to the levels that we've been at in the past. Now, in terms of housing starts, which obviously a lot of the folks that are involved in FGIA are on the commercial side, but housing starts are considered to be always a very good bellwether for how is the economy performing, and a good leading economic indicator of the commercial markets as well. So we do study those whether we're in the commercial or residential side or not. In March this year, housing starts dropped 22% versus the month before, February, when normally as we get out of that colder season, starts begin to pick up a little bit. Now, they were expected to recover only a little bit in April, but they actually ended up popping up 5.7% in April versus March. It was a better recovery than expected. And in the last day or so, builder confidence came out, again, a little better than expected, and showing that maybe some of the worst is behind us, hopefully, in terms of the housing market and the impact that we're going to see there. Obviously, only time will tell, but that's a possible explanation for that. Now, when we take a look at the impact of the last recession and really who suffered the most in that, residential companies, residential building product companies certainly suffered sooner than commercial companies did. The residential market took its lumps first, and then the commercial market softened 18 to 24 months after that. And in the residential side, new construction companies suffered sooner than remodeling companies, or companies that produce anything related to remodeling or contractors, anything in that nature. They experienced a much larger drop, typical 80 to 90% decreases. There were only a couple of pockets around the country, notably Texas was one of them, that performed well, and almost everywhere else to a greater or lesser degree, the market was, suffered. Now, what drove, though, the experience that a given company had was mostly how overheated was the residential real estate market in the area that the company was in. So places like Las Vegas, Florida, those were kind of overheated markets, and they suffered the most. They had the biggest run up and they had the biggest drop off. Now, in this recession, we take a look at it, and this is really being driven by a very completely external thing. It came out of nowhere, and give or take spread rates across the country, it affected everybody at roughly the same time. It was completely external to the fundamentals of our business, meaning the last financial crisis was fundamental to the building industry, and we are in the building industry, and so the two went hand in hand, as opposed to it being a tangential effect in the last recession for, say, a food company, where the housing market caused problems with the recession, led to the recession, and then other companies suffered. It was direct. Here it's external to us, so this time it's not inherent to our industry. And what really is determining how companies have performed so far, in our experience, based on the companies we talk to, is the state that they're in, how strict is the shutdown order, and how quickly is that state opening up. Meaning, if you're in one of the 6 states that didn't treat new construction as an essential business, you really have taken it on the chin the soonest and the most up to this point. Other areas, again, like Texas is a good example, is still doing very well because they've decided to continue, for the most part, operating construction and building-oriented businesses, and other states are sort of in between. The point is, I'm not advocating, a loose structure or a no shutdown or nothing to try to contain this. If anything, we don't, the jury's still out on the success rate of loosening too soon. There's some risk to that. I'm not making that statement. I'm simply saying that based on the accident of geography and where a given company happens to be, that's really what's determining how much their business is suffering at this point or not. So with that economic backdrop behind us, let's take a look at some of the concrete steps that we can take to safeguard the near-term profitability of companies. Now, I want to keep some of this very simplistic, and then we'll go into some detailed ideas. At the outset, obviously, if you take a look at your financial statements, there are only a few ways to improve the profitability of a company. You can increase revenues while holding other expenses relatively constant or in the same proportion. You can decrease your cost of goods sold or your sales, general, and administrative expenses. Catch all of other expenses, can address any of those individual variable costs, or your interest expense, which is driven by your borrowing. So with that being the obvious and most simplistic high-level view of it, let's take a look at some specific ideas. Now, as a backdrop to considering which expenses to cut and how to proceed, a lumberyard, president of a lumberyard at a recent presentation made an excellent point that their view is that they marry the mission and they date the model. And what they mean by that is the mission is you're serving your customers' needs in the very long term. And that's your mission, and you are irrevocably wedded to that mission. The model is the tactical ways on a day-to-day basis that you accomplish your mission. And especially at a time like this, it's cliche to say, oh, you should always be, reevaluating and restarting and rethinking your business. It's sort of a cliche, but at a time like this, it's an absolute necessity to make sure that everything about your business model, whether it would be the decision not to offer curbside pickup or things like that, those went from things a company might do to, in the building industry, things a company has to do. So it's important to sit down and really look at the tactics of what you're doing, and that's what some of the ideas I'm going to share today are about. But generally, just keep the long-term mission and be ready to change anything else about your company. Some of the ways to increase your revenues: cross-selling is very important. Take a look at customers that are currently buying certain products from you and certain products from another supplier. When the supply chain is completely up in the air and things are uncertain, that can be a very good time to get customers to want to consolidate with just one supplier, rather than have the double risk of, is this truckload of this type of product going to show up and then another type of product from another vendor. If they're all coming on the same truck, it's less complexity of the supply chain. Customers may go for that. upselling, if it's higher performance features, things like that. Once you've got a person that's about to buy your product, the biggest profitability enhancing idea in the world is to get them to buy a higher margin, better, more feature rich product from you, considering that they were about to buy something anyway. Optimize the manufacturing footprint. Now, that is another thing that's easy to talk about as a concept, but really in a time like this, it's an absolute necessity to rethink it. In lean and lean manufacturing, you don't want workers walking all over the plant to go get things. So you put them right next to each other on the line. You bring things right to their fingertips. You have shared little supermarkets of components and so forth, and everything, in other words, that is not social distancing in a new COVID economy type of plant. So people are having to reevaluate, should they move parts bins and things around to give a little distance? What do they need to do? And one of the ideas that we've come across is the notion of appointing a social distancing czar at each workstation or each company location that goes around and gives the, you're too close together, let's spread out, you're supposed to be spread out, or where's your mask, and companies try to make a little bit of a game out of it, but by appointing one person that job, nobody feels that they have to be, the bad guy, because it's accepted, hey, that's that person's job to point that out. So that's something certainly to consider. This is a good time to evaluate and invest in your sales force. Take a look at Salesforce and how well equipped are they now that face-to-face selling is sort of removed from the toolkit for a while. And some of the sales professionals we have in the industry are just masters of the face-to-face appointment. Are they going to be masters of a video appointment, of a web-based online appointment? And those interactions can be much richer than a phone call for a selling experience, and you want them to have those. But if your sales team is not comfortable with that medium, think of maybe pairing a more tech-savvy member of the team with someone who's a little less tech-savvy that's on the sales team, and have the younger person sort of MC the sales call. Now, then they get to sit in on a sales call and learn and get experience with that. They'd probably be fascinated with it if that's not the area they're in. And the older, maybe less tech-savvy employee gets a better experience and a more professional contact with their customer in a way that is smoothly done and not clunky and difficult. That can take some expertise. It's also important in a time like this to take a look at your employees' LinkedIn profiles. Is everybody being consistent? Is it a clean, professional approach? Your head of sales might be super proud of that big bass he caught last summer, but him hefting that thing in his LinkedIn profile, is that really the right move? Take a look at standardizing all of those and just make sure everybody's utilizing social media in a way that's beneficial to the company. Turning to the next idea, new products and services. Probably most companies have an opportunity right now to take a little bit of a whiteboard approach to some new products and services. I've been pleased to see some of the companies come in and switch over to temporary production of some of the personal protective equipment for medical employees. Now, that's not going to be a long-term market for them. Who knows if they're even pricing it in a way that they make money from it? No idea. It's a very patriotic thing and a great thing. Maybe explore some of that. But longer term, are there products that are now going to be demanded in this environment that weren't common in the future, like glass partitions? I'm walking into some, sandwich shops and things with a mask on, and the worker's got a mask on, and there's a sort of a sheet of plastic there. You get the idea, but that's not going to be there forever. That either will need to go away or will need to be replaced by a nice looking commercial glass partition, different things. Redesigning the commercial work environment, there will be opportunities there that should be explored. Take a look at your customers and compare one to the other. If you have a customer that's a certain size and serves a certain geography, and then there's another customer that's a similar size and geographic scope, but they're buying very little from you, there's an approach. Keep a pair and a spare. Keep a pair of suppliers and a spare supplier, so that you have somebody to compete on pricing, and you always sort of have a backup. Well, if you have a customer that should be buying a lot more from you and they're not, maybe you're the spare, heaven forbid, or maybe you're the lesser of the pair, because the first supplier in the pair typically gets the lion's share of the business. reach out to those customers, give a verbal case study, say, hey, we work with other companies like yours where we're able to help them in a lot bigger way. Is there anything we could do to earn more of your business? And just have those conversations with them. They'll appreciate you taking the initiative. We want to stress, knowing the product level and project level profitability of everything that you do, because it's easy not to account for all costs, and that might be unusual design complexity. If two end products look and act and feel about the same and have the same amount of material, but one of them had a gigantic amount of design complexity in it, or tangential manufacturing labor because additional processing was needed, whatever the case might be, you got to make sure that you're being paid for the value that you're providing to your customers. Need to know and understand those costs. Seek relief from your suppliers and vendors. Frankly, we're in touch with a lot of companies that have gone out, whether it's on their real estate leases, ask for extension of terms, some period where it might be interest only, and defer payments, add them on to the end. With leased equipment, if you've had to idle a line or a whole facility, take a look at it and call the company leasing the equipment and see if they might be able to take some of it back. Again, defer payments, play games with the payments. It's a time when people are willing to help out and try to make things work. Insurance costs, obviously shop around, but maybe it's a time to take a little bit of a chance with a lower deductible. If it gives you an overall lower insurance cost for the next year or 18 months, that's something to consider. Take a look at your critical suppliers and ask yourself, are any of these suppliers themselves at risk from COVID interruptions? Or, is there anybody that hasn't seemingly been able to keep their lead times the way they've indicated? Set aside whether they're as fast as they used to be, but are they as fast as the slower lead time that they're now predicting? And if they can't hit that lead time that's already longer than it was before, it makes you wonder how much control they have over their own supply chain. And maybe that's a riskier vendor. Take a look and make sure you're working with the right group of companies. Also, if you're switching suppliers on an international basis, especially country to country, make sure that you're not overpaying tariffs, taxes, duties, shipping fees. Really audit those, especially those first handful of invoices. Make sure you're not overpaying on any of those aspects. Another thing to mention, we have a new form of competition for workers that's very, very tough to beat, it turns out. Last year, a lot of the trade association meetings were about hiring workers, retaining workers, how to keep great staff. And as I put it before, the workers walking around our companies right now are like walking human bars of gold compared to how hard we fight to recruit them and keep them and grow them and develop them. And now companies find themselves in the regrettable position of laying them off. Well, particularly at the production level, the competition for workers is the fact that there's unemployment benefits, and some of them have enhanced payments that lower hourly wage employees can actually make more by being on unemployment than not. Now, if you offer that worker a job and they don't take it, you're supposed to report that to the Unemployment Security Commission, and then they lose their unemployment benefits. But if nobody wants to put the black hat on and be the bad guy, and the workers in those situations tend to cite concern about the COVID virus that you can't discern from a desire to just take advantage of a change in the system. And so you're left not being able to do anything. So what some companies are doing is paying bonuses that are designed to last as long as those enhanced benefits last, so that you can get those workers back. Utilize your trade associations. Trade associations are doing a great job of keeping their members informed. Best practices of the COVID situation, updated legislation, benefits from the government. All the trade associations have those sites. And don't forget to reach out to your trade association members and ask them what they're doing, because they're always going to be willing to share ideas with you. Now, in terms of enhancing profitability in the longer term, clean up your email list, your marketing list, make sure everything's pristine. If you're using a CRM, shop it around, see if there's a better one you could be using that captures data in a better way. Take a look at social media you haven't tried in the past. And if you have a competitor that is religiously using a certain social media, you can bet that they're having good success with it, because if they weren't, it would probably fall by the wayside and they'd stop using it. A lot of companies will post really attractive or unusual products on Facebook, Instagram, whatever the case might be. Take a look at what everybody else is doing out there, and wherever the crowds are going in terms of using that medium, that's probably the one that's working. Now, I initially on the description of this referred to this as reducing your investment in net working capital, but as we'll see, really the game of the game is not just reducing your investment in net working capital, but converting the part of your capital that's tied up as working capital, more in a greater proportion of it in cash. So again, a simple definition of net working capital is your current assets, which is your cash, your inventory, accounts receivable, prepaids, minus your current liabilities. I'm sorry, I had a message pop up about the potential signal. If you can't hear me okay, then I'm assuming somebody from AMO will grab me. The current liabilities, which is your accounts payable, taxes payable, interest payable, that number is your net working capital. Now, in the sale of a business, you remove from that cash, but in the ongoing operation of a business, the cash is the most vital part. And our goal is to reduce the amount of investment in inventory and AR and increase the portion of your net working capital that's held as cash. And we're going to talk about some ways to do that. Now, cash is critical. Harvard Business School study says companies have about 27 days of cash on hand. It's easy when we're in a boom time to throw money at problems with working capital, just as you throw people at problems in a boom time. And now all of a sudden we're in a lean time and cash is tight. You can start to miss out on early pay discounts, things like that. So it's really critical to manage your net working capital and get as much of that capital back into your business as you can. And it's believed that there's an opportunity in an environment like this to get as much as 30% of your working capital back as liquid cash to use in your business. Now, you can't get that back unless you know what you're measuring and know whether you're having success with some of these methodologies. So the first thing is to look at the key performance indicators for net working capital. The first one is days sales outstanding, which is your total accounts receivable for a given period divided by all the sales for that period that were conducted on credit, meaning not people walking into a retail type environment and paying cash for products. You should target a result of about 43 to 46 days. If you creep up to 50 days, that's too high, meaning people aren't paying you quickly enough. We'll talk more about that in a minute. Days payable outstanding is your accounts payable divided by your cost of goods sold times the number of days in the period. And again, that's you paying other people and how quickly you're paying them. So ideally, if you can pay other people just a little slower than everybody's paying you, then you have a source of financing there that can be viable. But if you stretch up toward, the 60-day mark, your vendors may start to charge you more because you're being a slow payer, and you may end up winning the battle and losing the war because you are a slow payer and now you're paying more for all your products. You'd maybe be better off to pay quicker and get better pricing. And then the final performance indicator is days inventory outstanding, which you'll sometimes see expressed as the number of times per year that your inventory turns over. And with that one, if you have a commodity, quick moving product, you should probably be turning that over virtually every month. So about 30 to 33 days of that product outstanding at any given time. If you have a sort of slower moving but higher margin and well-managed product, maybe it would be 3 to 4 turns per year would be a desirable aspect. So calculate this for your business and determine where you're starting. And then as you start to put some of these things that we're going to talk about in a second into place, you'll be able to tell the benefit of it. Now, drawing down inventory, the easiest way in the world to draw down inventory is to stop buying it. Just sell inventory and don't buy the next thing. That's very risky, obviously, because if someone calls you up to buy that thing and now you can't, produce a product or ship on a product you carry as a distribution basis, it's a problem. So not all inventory drawdowns are created equal. You need to look and see commodity items, lots of suppliers. They're located right by your plant. Great. Let that drift down, because if you need some, you can get it right away. If you have, products that are very customized, made to order, have a little longer lead time, the suppliers being a little unreliable in lead time, even if it's painful and means you have to stock up a little bit on that product, don't let that one drift downward, because it's going to cost you more than it helps you. And I should note, because I know I'm moving through these kind of quickly, the presentation slides will be available afterwards, so don't feel that you have to take notes on every single aspect of it. You'll be provided the slides. Improving collection of accounts receivable, that's converting accounts receivable into cash, which technically doesn't move the needle on your net working capital, but helps you because you have a higher portion of that working capital as cash, which is a very good thing. Make sure that your invoices are sent electronically, that they are sent absolutely as soon as possible, that they've been reviewed, are 100% error-free, because obviously if a customer gets that and there's a problem, they may take that as an excuse to say, oh, this is all fouled up, let's straighten this out and then we'll send you your payment. Now you're waiting to fix a couple $1,000 on a $100,000 invoice. It's a big problem. So make sure those are, are pristine and perfect. And if you do find yourself chasing somebody, chase the most recent AR first, because that's the one that's most likely to be paid. The longer in the tooth is tougher to collect. Quick caution, beware of that new customer. They may be calling you and have some big order they want to place, and you think, oh, great news, in this midst of all of this, we got this great customer. Maybe they got cut off by their other supplier because they dragged them out. At the very least, don't short the effort on your normal credit clearing process. Vet that new customer just as much as any other customer, so that you make sure you're getting business that you're going to get paid for. Key discussions to have with suppliers. If you have had to furlough or lay off workers to address this issue, then you should have no hesitation of going to your suppliers and asking them to help share the pain a little bit. Ask them for longer terms, lower break point schedules on pricing, lower rebate levels, because now you may not qualify for the rebate you got last year. A lot of companies count on that as a source of cash. Ask them whether or not they would be willing to keep inventory in your shop on consignment, and when you pull the ticket and start to use it, you give it to them electronically and they bill you for it electronically. You just want to be careful to make sure to have your suppliers contribute to your success at a time like this. Now, be aware of the challenges your customers are facing. Everybody wants to help, but when you get that customer that's in a little bit of trouble, and now that AR starts to pile up and pile up and pile up, now, the conversation in the last recession was, well, gee, if you can't roll with me, maybe I'll take my purchases to someone else. And now that that AR is going to sit there a while. So be aware of what your customers are facing. And as I mentioned, the trade associations have lists of, how different states are doing shutdowns or not, and so forth. Be aware of that. If you have a customer that serves a couple of states, take a minute, Google and look up if those aren't the state you're in, to see what's that customer's outlook in that state. Are they getting to do business or not? It's important to know that. Take a look at your existing credit facilities, and probably it's a good idea right now to draw them down. And if you can, deposit the money in another institution. If they call the loan, you'll have to return that money anyway, but it gives you a little more leverage to negotiate that if the money is sitting somewhere else than if it's sitting at the bank that's called the loan, or reduced your credit limit or whatever. In the last recession, there were companies that didn't want to do this, and they suddenly found the ceiling crunched down and hit them on the head when the banks lowered their credit limits, and other companies that were maxed out to the maximum were left alone for a time because the bank didn't want to call the loan and have that company fail, and then the loan goes bad. So consider taking that as liquidity and holding it as a hedge. Other ways to generate liquidity: 2/3 of companies being surveyed right now have reported that they're going to delay some capital expenditures this year until next year. Just keep hold of that unless it's critical. They just hold on to it. Real estate sale leasebacks: if the company owns its real estate or the owner owns its real estate, they can sell it to an institutional real estate investor, generate liquidity, and then lease the real estate back from them. And it turns the real estate asset, which is very static, into a dynamic cash asset that can be used for other things. Factoring is kind of a dirty word in the financial industry. It's always a sign if your best customer called you and said, hey, I just want to let you know we're going to be factoring all of our own accounts receivable now. That would be an oh no moment, because it would mean that they were probably in financial trouble. That being said, if a company hits that point where they do need to have liquidity in a kind of a no matter what scenario, it's better to have that idea in mind than not have it in mind and not get to use it. And it's important as you're working with your net working capital needs to make sure that you're doing a 90-day rolling model of your future cash flow needs, so that you can predict spikes and peaks, and frankly can see on a month-to-month basis whether the working capital methodologies you're putting into place are working, and make sure that it's having the effect that you want, and not be caught off guard with the need for cash, especially if you're at or near your credit limit. It's critical as businesses begin to grow also. That can be as strong a signal for business failure as a slow economy, because you get hit with the need for growth capital and you don't have access to it, and then you're in trouble. So important to model that out. Now, the last topic that we want to talk about, and then we're going to turn it over for Q&A, is assessing business valuations in a post-COVID environment. And this could be your own valuation or that of a potential company to be acquired. And to be clear, there's not enough information in this few minutes to actually conduct a valuation of your company, but it just gives some conceptual ideas that I think are very important. So there's a group out there called Gen 2 Fund Solutions. I'm not connected to them in any way, but they're a company that performs services for PE funds. And so they did a survey in April, this April, right in the midst of the COVID situation, of 150 different private equity funds to just sort of see how are they seeing the world. And 80% of those funds predicted that there would be as much as a 25% reduction in the value of their current portfolio companies for reporting purposes. Those are funds that have to report to the SEC every quarter. They thought their companies might be mark to market down about 25%. There's a lot of uncertainty reported in the survey, and it was indicating, and this is what I found interesting, that some of the PE funds were going to supplement traditional valuation methodologies with some other approaches. And we'll talk about the more traditional method in a minute, but one of the methods was public comparables. Well, that means they're going to look at how big public companies are trading on a price earnings basis and apply that same earnings multiple to the value of their own companies. The problem with that, and these red notes there are my notes, I didn't want them to be confused with the information the survey was providing, my comments and opinion on it, is that when companies are so much smaller than a public company, the multiples really aren't applicable. You have to do such a huge size and lack of liquidity discount that methodology, it really becomes almost, what do you want the valuation to be? You get to pick. Third-party valuation services to use those, that's fine too, but they use the same discounted cash flow and public market comps numbers as everything else. The public comps have the vulnerability I just mentioned. The discounted cash flow model is highly subject to what the future interest rates are, the future growth rates are, and the assessment of the company's risk relative to the market as a whole. Those are all blunt instruments in those typical valuations that, again, that basically you choose what you want the valuation to be by tweaking those numbers. And then adjustments to the previous traditional methodologies, which we'll talk about in a minute, because those are probably the best ones to use. Now, in the last recession, the number one predictor of business failure was companies having too much debt. We think that's going to be the same in this case. You can right size your other expenses, you can lay off employees, you can cut spending on travel and entertainment. Debt you can't change, and the day-to-day cost of your facilities you can't change. And so companies with too much debt, second place being companies with facilities that were built too big on purpose so they'd have room to grow into, those companies are going to be in the largest challenge. And if we hit a period here where enough of those companies are experiencing pain, we'll see debt-driven business sales as we did in the last financial crisis. So here's how post-COVID valuations might work. First of all, companies are going to take a look and they're going to say, well, at the macro level, do I even want to be buying? And what they're going to base that on is, are the infection rates dropping? Are the mortality levels dropping? Is unemployment returning to normal? Are new claims of new people getting laid off? Have those stopped and now they're returning to normal? They're then going to look at the company and say, well, what's the backlog of booked business compared to where it was in 2019? What are the revenues this month compared to the normal month last year when, a more normal market? Are they getting new customers? Are they winning, new projects? And frankly, can they even operate? They're going to take all those things into account. So challenges in this post-COVID environment. First of all, right now, the dominant valuation methodology in the country is EBITDA multiples. Take the earnings before interest, taxes, depreciation, and amortization, EBITDA of a business, essentially a proxy for cash flow, and you throw a 6 times multiple against that as an example for a company with, say, 5 million in EBITDA, just for example purposes. That's 6 times 5 is 30 million, okay? That's how most businesses are valued today, and we think that's going to continue to be the case post-COVID. The challenge is going to be the sellers aren't going to want to sell their businesses at a discounted value simply because of having suffered a little bit during the COVID experience. And buyers are going to be worried that they're going to overpay for a business. They're going to be wary of that, and they don't want to overpay for the business. So they would have a tendency to want to lower valuations. So the way that you resolve that challenge, and obviously the right valuation is the one that both the buyer and the seller can agree on, and leave both of them feeling that they got a relatively unfair or equally fair or unfair deal, depending on whether you see the glass as half full or half empty. Now, if there's no agreement on the price and the terms and the structure, then that's a deal that doesn't happen and you never hear about it. But if you hear about a deal, then you can assume that the buyer paid what the seller was willing to sell for. So you look at that and you say, okay, well, what will we do? Well, there's a couple things we could do to be able to value a company in this post-COVID environment. We could take the months, wholesale lift them up out of the financial statements that were affected by COVID in 2020 and just replace them outright with the months that are not affected by COVID in 2019. I think that's highly unlikely. It's heavily in favor of sellers. It would be great if it would happen. I don't know that that's going to be the case. There certainly will be, use of those year-on-year comparisons to test, but I don't know that buyers are necessarily going to agree to that. It's more likely that they will go in a couple of different routes, either earnouts, where the seller gets additional purchase price in exchange for hitting certain liquidity goals, or hitting an earnings increase goal, getting back to quote normal. Because if you had a crystal ball and you knew that the business was going to nicely recover exactly back to where it was prior to the recession, then you would have no problem paying a forward-looking multiple on forward earnings and be confident that they were going to occur. But if you're not confident in that, you employ a method out like an earnout, where everybody gets to be right. If the earnout doesn't happen, then the buyer was right and they paid the right price at the closing. And if the earnout does happen, then the seller was right and the business had more inherent value locked up in it than would be easily to be believed on the surface. So it's a way for both parties to be satisfied with the outcome at the end. And then the other opportunity is if a buyer is willing to allow the seller to continue to own some of the equity of the business afterward, is to say, let's have the seller do an equity rollover. And then they get essentially a second kick at the can, as we call it, or second bite of the apple, because they've maintained some ownership in the company. And the funny thing about the way that deals usually get done is that you borrow money when you buy a company. So if a business owner sells and they end up rolling 10% of their equity into the deal because there's debt used on the deal, that 10% can balloon in value and they end up actually owning 20% of the business. They're sometimes kind of surprised by how much they own in an equity rollover. So that's a valuation method, or a method of sort of bridging that gap between the two parties that can be very highly effective. So the last thought that I wanted to share prior to turning it over to questions and answers from the group. First of all, I guess I just want to say that my hope today was to share with you some ideas that would, make you write down that idea and say, oh, I want to look at that for my company. That's, not every one of these ideas is applicable to everybody, but some of them should be applicable to everybody. And to have you just look at one and follow up on it later and put something into place in your company that helps you save money or frees up working capital. That was our goal today, to help anybody joining the call. Also, I want to just share my own personal thought that as you watch the news or you get these newsletters, I get a lot of newsletters from different groups, consultants, and so forth. And some of them, the subject line of the email should probably be, all hope is lost, or, doom is upon us, or something terrible like that, because they paint just the worst, most dire future. And you get this growing suspicion as you read it, and it's confirmed at the end that, lo and behold, but don't worry, they have a consulting methodology that will save you from that dire future, and just sign up and, so forth. So just be aware when you're getting those kind of, pseudo news updates from consultants and so forth, that, a lot of times they're selling a solution to a dire picture that they themselves have painted. Just be kind of wary of that. On a very personal level, stay safe, stay healthy, and, wish everybody the best and their employees the best. And we're all sort of adjusting to these unusual and unique times together and piecing our way through all of it. And I know my three little vice presidents are at home taking a break from quarantine homeschool to listen in on this. So things are different than you'd expect. You wouldn't have expected that to happen. So let's just all get through it, stay safe. And I look forward to seeing everybody at the FGIA virtual summer conference. I'll be moderating one of the discussions for that conference as well. So with that, I will ask Janice if she has some questions teed up from participants. I believe some of them were submitted ahead of time. Happy to cover a couple of those if you'd like, Janice, or if you've had some during the presentation, whatever you like.
Yeah, thanks so much, Mike. Really, there were a lot of great actionable tips and strategies in the information you provided. So we certainly appreciate that.
Yeah.
As Mike mentioned, the floor is open for questions. If you have not already, please send those in via the chat box. We'll address as many as time allows. If your question doesn't get answered during the live session, we'll try to provide a response by email. We do have a few questions here already. The first one, Mike, is will the COVID recession be as bad for building products companies as the financial crisis?
Yeah, good question, and open to a lot of opinions. My personal opinion is that it will not. The last recession was this long, slow tumble down a hill, and workers that got laid off in that recession went and found other jobs, and there was a lot of shuffling and inefficiency in the economy. There's a very good chance here that as we recover, the very same people that have been laid off from a job will be the same people going back to take that same job back, and companies can pick up and be operating again at the nearly the same level of efficiency. You multiply that out through the whole economy and other factors, again, of the speed and suddenness of it, and the fact that it's an externality and not some inherent toxic aspect of our economy like the mortgage crisis was. I do think it will be less severe, less long, and less of a trial than the last recession. Setting aside, again, the human aspect of it, it will be less economically painful and protracted.
Yeah, well, that's great to hear. It's nice to get a little bit, see a little bit of light at the end of the tunnel.
Yeah, for sure.
Our next question is, how are building products manufacturers and distributors performing so far in the COVID-driven recession?
Well, I can base that primarily on conversations that I have with companies out in the market. And there are sort of two extremes. One extreme is the company that would say, what pandemic? They're crazy busy. They've, some of them have had, March was the same as March of last year. That's not too hard because COVID only really took hold at the end of the month economically. But then April was better than last year's April. That's really noteworthy. They already have enough book business for May to be better than last year's May. So the point is, those are group companies that are in areas that are still operating and still open and have customers that are still operating and still open. And you could say, well, maybe they're working through a backlog that's going to subside. Sure, there will be a bubble moving through that pipeline at some point that they should hit something softer at some point. But when you can continue to execute all that through the bad period, it's a very good sign. The other extreme are companies that unfortunately are located in areas that had tougher shutdown rulings, and they lost, the month of April in terms of revenue. And those companies are really having to be very nimble and creative to get their earnings back on track. And so it's really, that's where the geography of it kind of creates the haves and the have-nots in this recession.
Yeah, and hopefully there may be some opportunities for some of the companies that especially have been suffering in these recent months to maybe take advantage of some pent-up demand in the coming months as things start to open up in different geographies.
Absolutely. As one company pointed out, you've got people at home quarantined, can't go out to bars and restaurants. So you started looking around this place you're in, and there were times when, for a number of weeks, their paint sales at Home Depot skyrocketed because people were out, buying paint because they were in the place, and I guess I do have time to paint that upstairs bedroom or whatever. And they're doing those things, and it moves in waves as they track companies that track these kind of purchases. People are remodeling the homes that they're in. They're focusing more on home offices and making space more convenient, making a private set aside space in their own house that they didn't have and didn't realize how badly they needed until this crisis. It's changing a lot of the remodeling patterns sooner, and then might change in terms of the construction patterns. One of the ways that it's changing is people that are in apartments are now itching to get that first starter home, because so much of this COVID response was spacing and distancing. And you can't space or distance when you don't control all the people that move in and out of the structure you live in. meaning you get to the mailbox and your non-masked neighbor bounds up and says hello. Well, now you're in it, versus in your own home, you can control that. So starter homes are performing very well right now.
Yeah. We have another question here. How are companies retaining key employees? Are employers looking at short-term versus long-term needs?
Mm-hmm. Yeah, it's a great question. And I would say that employers are very much looking at the long term. They're doing things like continuing to pay medical insurance expenses for furloughed workers. So, you have the negative aspect that at certain wage levels, even the extra bonus unemployment money doesn't cover what you are making. You're making less, but you still have health insurance. They are definitely keeping employees that in a perfect world where you could just put an employee on a shelf and not pay them for 2 months and then come pluck them off that shelf and pay them again with no hard feelings, they might consider doing it. They're not doing it because they need those employees to understand how valued they are and keep them there. So I would say employers are definitely doing whatever it takes to keep their best and key people. As companies look at having to furlough workers, there's always a few that are, maybe easier cuts to make. But when you fought so hard to get your employees, those next few cuts all start to get very difficult, and they don't feel like excess or unneeded, staff. They feel like vitally needed people. So they're definitely keeping people around. Yeah.
Yeah, and certainly companies, I'm sure, are struggling with how to do that and be ready and positioned to properly handle the recovery that's coming. And surely there were some lessons learned coming out of the last recession.
Sure. Well, look at the companies in the last recession that went out and bought equipment at auctions. I mean, I heard stories of people going in and buying entire automated window lines for $25,000 from attorneys that were handling bankruptcies that didn't know a window line from, the desks and furniture. They didn't care what it was. They wanted it done and taken care of and sold, and just first one to hit my desk with a check gets to buy it. Well, some of those companies mothballed those things, and then when the recovery came, they had an entire paid for window line to spring into action. Imagine the impact that had on their profitability.
Right. But Mike, we have, we have one more question here. What is the biggest mistake a building products company could make in the current environment?
Well, I would say the biggest mistake would be to in any way underestimate the seriousness of this virus, in terms of how sweeping its impact can be on the employee base. We've talked to companies that have had that one sick employee, and now you've got to reintegrate that employee back into your operation. How do you do it? How do you make everyone else feel comfortable? I would say, the mistake would be to do anything other than err on the side of safety when it comes to workers. I've had a worker exposed to someone who's COVID positive, but I don't think the worker is. Well, let's find that out at the end of a 2 or 3 week quarantine where they get tested. Let's not take the chance, because once it gets in a company, the whole thing shuts down. Now everybody's quarantined. It can snowball beyond belief. So just take it real seriously and just over communicate to the extreme. Let your employees know that you're thinking about it on a daily basis. And, if they can come up with a few simple practices where they are, not having to necessarily think about it every minute of every hour, other than the basics of, hand washing and all the common sense things that we all need to be doing. If you're thinking about it and implementing it, they'll follow your lead and make it part of the company. I mean, one of the early submission questions that came in, Janice, was, are conventions and trade shows a thing of the past? And, I would vehemently hope not, because they're wonderful, and there's no better way for all of us to get together and see 20, 30 companies in a couple day period and talk to, they're just absolutely outstanding leverage in terms of resources. And I would say the groups that we're in touch with that hold trade shows, you wisely decided to make your summer event virtual. I think anything else would have been crazy, But, you know, the events that are held sort of next spring and next summer, folks are trying to redesign the way the trade show looks and acts and be able to, you know, have consistency with the social distancing and maybe, you know, not shake hands, no contact, that kind of thing. But yeah, I think the industry is trying to find ways to still have them. It's not guaranteed yet, but they're certainly trying to find ways to still have trade shows and conventions.
Yeah. But Mike, we've had one more question come in here.
Mm-hmm.
How will COVID affect M&A activity in the industry going forward?
Mm-hmm. Yeah, I mean, there's a definite wait and see period right now where, you know, I don't mind saying we're working on some deals that were put on hold because buyers said, why don't we just wait and see? You know, let's wait and see what we know and find out. You know, each week we learn more. You know, a couple of those groups have now come back and said, let's start to cautiously, I don't know, they could have qualified it any more ways. Let's start to cautiously explore ways to find a path forward toward a closing, which normally might have been taken almost as an evasive statement. In the midst of everybody else, you know, saying, let's wait and see, that sounded so positive. It felt like a great change, you know, but that's what'll happen. No one's going to introduce new deals right now. If someone called and said, hey, I want to sell my company today, you wouldn't start it today, you know, most likely. You would sort of wait and see, you know, over the next couple months, but it'll pick back up. And what I'm actually seeing is that we've had more inquiries where companies that came into this pretty cash flush have said to me, hey, I want to buy a company that has this product or that serves this geography or this price point or whatever. If you come across anything, let me know. And there's something about being on the buy side that's more naturally optimistic, I guess, because you know the business and you know exactly how it would tuck into your own company. And it's not like the business owners of building products companies run shrieking out of their business every night at the thought of being in the building products industry. So the thought of buying another company that's also in that industry is a pretty natural thought to them. So it'll come back, but it's in a definite, you know, it's in a definite slow period. We'll see some deals announced, but not anything like we were seeing up until you know, January, February.
Yeah, definitely. With so much uncertainty, you know, I think those statements apply to a lot of things.
Yeah,
right
yeah,
now.
they do. Yeah, buying equipment, a lot of things. The people are in uncertainty. You pull hard on the reins and look around, and that's exactly what's happening right now.
Right. Well, Mike, thanks again so much. We really appreciate you sharing your time and your expertise with all of us today. That brings us to the end of today's webinar. A PDF of the presentation and the recording of this webinar will be emailed to everyone later this week. You can also find these materials at the links provided here for members and for non-members. Many of our FGIA webinars are for members only. So if you're not yet an FGIA member, we'd like you to consider joining in order to make use of all the benefits that are available. You can call or email the FGIA headquarters for complete information, and we'll certainly be glad to speak with you or send you the details. And by the way, all participants will receive a survey following the close of today's webcast. We request that you give some thought to what the survey asks and provide your response. We do review them carefully, and participant input is important to our future program planning. As a reminder, the upcoming FGIA Virtual Summer Conference will provide more information on how businesses have been impacted by COVID-19 and the steps they can take toward recovery. If you visit this URL for additional details on registration and to view the preliminary schedule and speakers, as Mike mentioned, he will be moderating one of the sessions during that event. So thanks again to all for participating today, and thank you for your continued support. For FGIA's Teaching Tuesday webinar series, I'm Janice Iglesias. Have a good day and a successful week.